Let's transport ourselves back to the start of the new millennium, January 1st, 2000. After 2 decades of grueling effort, you've successfully accumulated a neat nest egg of $105,000 in your brokerage. It's all invested in what feels like a sure thing, a dependable S&P 500 index fund. You're familiar with the historical data. You're counting on that consistent 9% annual trajectory to secure your golden years. Jump ahead a full decade to New Year's Eve, 2009. You've navigated 10 years of massive global shifts, political changes, and personal life events. You crack open your portfolio statement, anticipating a balance nearing $250,000. But reality hits hard. You see $93,500. Not only did your wealth fail to grow, it actively shrank. Nominally, your average yearly return clocked in at negative 1.1%. When adjusting for inflation's eroding effects, your real purchasing power at the checkout line is down by roughly 22%. This isn't some financial ghost story designed to scare rookies. This is recent, documented history. In finance, this period is known as a lost decade. If your current retirement blueprint assumes a repeat performance is impossible, you are gambling dangerously with your future financial security. Before we crunch the numbers on navigating a stagnant market, I'm Pam, and I want to clarify exactly why this topic is critical right now. So much online financial guidance rests on the always up and to the right delusion. It presumes that given enough time, the S&P 500 cures all ills. However, if you are within 5 years of hanging up your boots, or already drawing down your savings, enough time is a luxury you likely lack. Grasping the dynamics of a lost decade offers the highest return on investment for your time today. It's the deciding factor between a confident retirement and being forced back to the grind at age 70 because the charts went horizontal. If data-driven deep dives like this are valuable to you, please help out by clicking subscribe. It signals to the platform that viewers genuinely want hard truths about risk, rather than just hype surrounding the latest tech trend. We're cultivating a community here that prefers preparation over nasty surprises. Now, let's examine the stark figures from that 2000 to 2009 period. Labeling the market as flat is easy in retrospect, but it fails to convey the emotional turbulence of experiencing it in real time. You didn't simply arrive 10 years later with a smaller balance. You endured two of the most devastating bear markets in modern times. First came the dot-com crash. Between 2000 and 2002, the S&P 500 wiped out roughly 48% of its value. It was an agonizing slow bleed that made investors doubt the validity of the entire new economy. Just as the index painstakingly fought its way back to previous highs by 2007, the global financial crisis struck. In 2008 alone, the market plunged almost 38%. From the 2007 peak to the early 2009 trough, you faced a total drawdown exceeding 53%. Consider the reality of that scenario. You spent 7 years waiting just to break even, only to watch half your capital disappear again over the next 18 months. Stating an annualized return of negative 1.1% sounds like a minor statistical blip. Yet, living through it daily, witnessing your life savings vaporize twice in a single decade, feels apocalyptically bad. The path downward wasn't a straight slide. It was a serrated edge cutting in both directions. Dimensional Fund Advisors frames this era perfectly as the tale of 2 decades. It serves as the ultimate example of why recency bias is so hazardous to your wealth. If you examine the stretch from 2010 to 2019, the S&P 500 was an unstoppable force, delivering approximately 13.8% annually. If that recent decade is your only reference point as an investor, you likely believe stock market gains are effortless. You buy a dip, wait briefly, and collect your reward. Yet, that golden run was only set up because the preceding period was so abysmal. During the 2000s, people were actively abandoning equities. They became convinced real estate was the sole safe harbor, right up until 2008 shattered that illusion. Prior to 2000, investors grew accustomed to the massive returns of the 90s, believing the fiesta was permanent. The 2000s served as an icy wake-up call. The crucial lesson here is that the market is under no obligation to provide a positive return over any given 10-year span. Shortly, we will examine a portfolio architecture that actually generated profits during that stagnant period. But first, we must accept that the S&P 500 isn't an unstoppable natural force that only ascends. It is a basket of businesses that can, and do, remain submerged for extended durations. I frequently hear folks argue, well, Pam, even if prices went nowhere, surely the dividends rescued the portfolio. It's a valid consideration. Dividends are often the unsung champions of total return. However, during a genuinely lost decade, dividends often serve as merely a small bandage over a gaping wound. If the index price drops 1.2% annually and the dividend yield is 2.2%, you are only up a meager 1% before inflation hits. And inflation is the true assassin here. During the 2000s, inflation averaged roughly 2.7%. If your portfolio grows at 1%, while the cost of living rises by 2.7%, you are hemorrhaging purchasing power daily. Most folks fixate on the number, that balance flashing on the screen. Yet, that figure is irrelevant if it purchases half the groceries and gasoline it once did. A stagnant decade in nominal numbers is an absolute catastrophe in real terms. This is exactly why a 100% S&P 500 strategy carries far more risk than historical averages imply. It offers high-octane fuel when it works, but becomes a lead anchor when it fails. To understand how much worse it can get, we must look beyond U.S. borders and address the specter of the Nikkei. If you believe a 10-year plateau is severe, allow me to present the Japanese stock market of the late 1980s. On December 29, 1989, the Nikkei 225 peaked at an all-time high approaching 40,000. Back then, Japan's economy was globally envied. It seemed they would acquire every prime real estate asset in Manhattan and London. Their corporations defined efficiency. Being a Japanese investor in 1989 meant feeling absolutely invincible. Then that massive bubble popped. In just the first 2 years of the 1990s, the market nosedived by 62%. But the truly terrifying part, the part that should cause insomnia, is what happened next. It didn't simply rebound. Recovery didn't take 10 years. It took nearly 32 years just to regain those 1989 levels. For 3 full decades, domestic Japanese investors who bought at the top were underwater. That isn't merely a lost decade. That is a lost financial generation. It represents a total failure of the buy and hold philosophy if you limit yourself to a single nation's equities. When I observe investors today dumping 100% of their capital into U.S. tech stocks under the assumption they only rise, I see the long shadow of Tokyo circa 1989. This isn't exclusively a Japanese issue either. The U.S. has endured its own agonizing sideways grinds that are conveniently overlooked on long-term charts. The period from 1966 to 1982 was another 17-year span where real returns were effectively zilch. Viewing a logarithmic chart of the U.S. stock market since 1871 reveals what looks like a perfectly smooth upward staircase. However, zooming in exposes massive, stagnant plateaus. Between 1966 and 1982, the Dow Jones Industrial Average began around 1,050 and finished around that exact same level. 16 years of volatility, economic drama, and high inflation resulted in zero price appreciation. If you were attempting to fund retirement during that era, you weren't just bored with the market, you were likely desperate. Inflation ran rampant in the 70s, meaning that $1,050 in 1982 purchased only a fraction of what it did back in 1966. It is hard to overstate the psychological toll of such stagnation. Most investors capitulate long before the 10-year mark hits. They see neighbors profiting in gold, real estate, or the current trendy asset, and they abandon their own strategy precisely at the market bottom. A lost decade is dangerous not just because of the math, but because it tempts you to quit the game completely. As we'll soon demonstrate, if retirement is on the horizon, quitting isn't an option, and the mathematics get even crueler. If you are in your 30s, a lost decade is genuinely a gift. You are a net buyer of equities. Every month, you deploy capital at depressed prices, accumulating more shares that will eventually surge in value. But if you are 62 with plans to retire next year, a lost decade is essentially a financial execution. This introduces the critical concept of sequence of returns risk. Most folks fixate on average returns. They reason if the market averages 7%, I can safely withdraw 4%. Yet, the market never delivers a steady 7% annually. It hands you 30% one year and negative 20% the next. If those negative years strike right at the start of retirement, while you are simultaneously withdrawing funds for living expenses, you compound your losses. You are forced to sell shares while they are on sale, leaving you with fewer assets to benefit from the eventual recovery. Two investors might achieve the identical average return over a 30-year span. However, if investor A suffers bad years early on, and investor B hits bad years at the end, investor A might go broke by year 15, while investor B leaves behind a multi-million-dollar surplus. The sequencing window, the 5 years immediately preceding and following retirement, is the most critical financial decade of your life. Let's apply some concrete numbers to this concept. Imagine retiring in the year 2000 with a nest egg of $1.1 million. You decide to adhere to the famous 4% rule, withdrawing $44,000 annually, adjusted for inflation. By the end of 2002, following the dot-com crash, market losses combined with your withdrawals shrink that portfolio to perhaps $650,000. You still need that smaller pot to generate the same inflation-adjusted income. Your effective withdrawal rate has suddenly leapt from 4% to almost 6.8%. That rate is completely unsustainable. Then, just as recovery seems possible, 2008 strikes, slicing your portfolio yet again. Even though the 2010s hosted a massive bull run, your assets might have been so depleted by then that insufficient capital remained to capture that growth. You cannot bake a cake if you have already consumed the flour. This reality is why Morningstar research suggests a truly safe withdrawal rate in today's high valuation environment might be closer to 3.4%. They are accounting for the very real possibility that the coming decade will resemble the 2000s more than the 2010s. Ignoring this and clinging to outdated rules means betting your retirement on a coin toss. So how do you construct a portfolio that won't just sit uselessly like a decorative rock for 10 years? The solution is the one concept everyone loathes hearing when the S&P 500 is booming: diversification. During the S&P's lost decade between 2000 and 2009, not every asset class was bleeding red ink. In fact, looking outside the U.S. large-cap arena revealed a reasonably decent time to be an investor. Emerging market equities, for instance, enjoyed a fantastic run during that span. Global bonds offered reliable income and capital appreciation. Small-cap stocks and value-oriented equities significantly outperformed the tech-heavy S&P 500 index. The asset class performance rankings from 2000 to 2010 are almost a perfect mirror image of what we've witnessed over the last 10 years. Back then, the US lagged while the rest of the world led. Today, the roles are reversed. But remember, these cycles always turn. The investors who survived the 2000s intact weren't the ones who predicted the crash. They were the ones who were globally diversified. They didn't wager their entire future on a single index. They owned developed markets across Europe and Japan. They held emerging markets like Brazil and China. And they maintained high-quality bond positions. When the US market stalled, their other investment engines kept humming along. Diversification is investing's only free lunch, but it only tastes appealing when your main course has spoiled. Beyond mere geography, you can also diversify by factors. Factors is just a sophisticated way of saying you should own distinct types of companies, not just the largest ones. Dimensional's research indicates that over the full 20-year window from 2000 to 2019, a portfolio tilted towards small-cap and value companies, those priced cheaply relative to their fundamentals, actually bested a pure S&P 500 allocation. Despite the S&P's monster run in the 2010s, the outperformance of value and small caps during the 2000s was significant enough to win the long game. Many people are closet indexers. They buy an S&P 500 fund, assuming they are diversified, simply because it contains 500 names. Yet, those 500 names are all large-cap U.S. stocks, currently heavily concentrated in just a few massive tech giants. If tech goes sideways for a decade, the entire S&P 500 goes with it. By owning a broader market slice, small companies, value players, international firms, you create multiple avenues for success. It's about eliminating single points of failure. Next, we'll examine the boring segment of the portfolio, the part everyone ignores until the building is ablaze. Let's talk bonds. In an era of crypto and triple-leveraged ETFs, bonds seem about as thrilling as watching paint dry. Yet, in a lost decade, bonds are your closest ally. They serve two vital functions. First, they provide stability. When the S&P 500 is down almost 38% as it was in 2008, high-quality government bonds are often flat or even positive. They act as portfolio shock absorbers, preventing your total balance from cratering. Second, and most importantly, they act as dry powder for rebalancing. Rebalancing is simply selling what has risen to buy what has fallen. During a flat decade, the market doesn't sit still. It oscillates wildly. It drops, rallies, and drops again. If you hold a sleeve of bonds, you can sell them when stocks are in the gutter to buy more equity shares at a deep discount. This buy low, sell high mechanism happens automatically when maintaining a target allocation, like a 65-35 split. Research shows that shifting to such a balanced portfolio during that critical retirement window can slash volatility significantly. You may sacrifice a small fraction of average return, but you drastically increase the odds that you won't outlive your money. In the retirement game, remaining solvent is far more important than winning big. Now, let's explore the advanced tactics, strategies that function even when both stocks and bonds fail. There is a nightmare scenario investors rarely discuss. What if stocks and bonds both flatline simultaneously? We caught a glimpse of this in 2022, when spiking inflation caused both asset classes to fall in tandem. If we enter a prolonged period of high inflation, the traditional 60-40 portfolio may struggle profoundly. This is where alternatives enter the picture. I'm not referring to shady crypto schemes or high-fee private equity funds. I'm talking about liquid alternatives with low correlation to traditional markets, things like managed futures, trend-following strategies, or real assets like commodities and tips. Catalyst Funds has conducted interesting research on positioning for a lost decade where both stocks and bonds stall. They suggest adding a long-short sleeve, essentially a strategy that profits when markets decline as well as rise, to buffer portfolio volatility during flat or bear markets. The goal isn't hitting a home run, it's finding an asset that marches to its own drumbeat. If the S&P 500 is a rock and bonds are a hard place, you need an asset that acts like a sponge. By diversifying into areas that don't rely on equity growth, you create a portfolio capable of generating positive returns even when the primary market is broken. It's about building a ship that sails even without wind. If the mathematics of a lost decade seem overwhelming, remember, there is one lever you control completely: your spending. The biggest error retirees make is assuming they must withdraw a fixed, inflation-adjusted amount annually, regardless of market performance. The 4% rule is built on this assumption, but in reality, it's an incredibly rigid way to live. Instead, successful retirees utilize flexible withdrawal strategies. This means in a year when the market is down 10%, you might skip the inflation adjustment or slightly cut discretionary spending. Conversely, in a monster year where the market is up 20%, you don't spend all the gains, you cap your increase to maintain a buffer for lean years. This guardrails approach allows you to withdraw more money on average while drastically reducing the risk of portfolio meltdown. It's about being an active manager of your own financial life. If you can maintain just 6% to 12% flexibility in your annual budget, you can survive a lost decade that would bankrupt someone following a rigid rule. We often focus so intensely on investment returns that we forget the spending side is where the true power lies. So let's synthesize this into a practical protocol you can implement immediately. Rule number 1. Accept that lost decades are a normal component of market history. They aren't black swan events. They are the price of admission for long-term gains. If your financial plan shatters because the S&P 500 returns 0% for 10 years, your plan is already broken. Rule number 2. Diversify geographically and across factors. Do not be a US-only investor. Hold developed markets, emerging markets, and value tilts. This ensures that even if one economic engine stalls, the others keep you moving forward. Rule number 3. Manage sequence of returns risk as you near retirement. This means adding high-quality bonds or perhaps a tips ladder 5 years before you plan to stop working. View it as an insurance policy against a disastrous start. Rule number 4. Utilize a conservative withdrawal rate. If retiring today, assume a range between 3.4% and 3.8%, not the standard 4%. If the market performs better, excellent. You can increase spending later, but always begin with a margin of safety. Finally, rule number 5. If you are still in the accumulation phase, pray for a lost decade. A flat market is essentially a 10-year fire sale on the world's most productive assets. Your ongoing contributions and rebalancing will be the primary drivers of wealth during those years. A lost decade is only truly lost if you stop participating. The S&P 500 is a formidable wealth-building tool, but it is not a magic wand. From 2000 to 2009, it proved it could go nowhere for a very long time, leaving a generation of investors stranded. Japan proved markets could remain underwater for over 30 years. These are the cold, hard realities of the financial world. The investors who thrive aren't the ones lucky enough to pick the next NVIDIA. They are the ones who construct portfolios designed to survive worst-case scenarios. They hold global stocks, boring bonds, and keep their spending flexible. They don't bet their entire financial future on a single index or a single country. As we move into an era of higher valuations and uncertain growth, the lessons of the lost decade are more vital than ever. Don't let a decade of zero returns catch you off guard. Build your plan today so that 10 years from now, you are the one looking back with confidence, while everyone else wonders where their money went. If you want to see what a sample asset allocation looks like for your specific horizon, leave a comment below with your age and risk tolerance. I can't give specific advice, but I can sketch out the math for you. Thanks for watching and stay optimized.